Hello everyone, this is Manjula Devi P, working as Assistant Professor in GFGC Kanakpura. In this session, I would like to discuss about the efficient market hypothesis and its implications. So we'll see what is the meaning of efficient market hypothesis, which is called EMH, alternatively known as efficient market theory, EMT. It is a hypothesis that the share prices reflect all the information and consistent excess return is impossible. So that means, according to this hypothesis, the market price of the security represent all the factors which is available, means which affect the share prices. So it is like the perfect price available for the market at the given point of time. So according to this, stocks are always traded at their fair value. Like there is no chance of undervaluation or overvaluation, or there is no undervalue or inflation prices of the stock, because at any given point of time the price which is represented is the fair value of the stock. So it is impossible, according to EMH hypothesis, that because of any technology or technique, or because of any expert selection, you cannot sell the stock at a higher price, or you won't be buying the stock at the lower price. Always the stock is dealt at its ideal or fair price. What are the assumptions of EMH? First and foremost assumption is the free flow of information in the market, means all the information related to the security prices are available to everybody at any given point of time. Okay, so everyone are informed about the market conditions. Then the transaction costs like commission or brokerages are nil. There is no transaction cost. And it assumes all the relevant information is reflected in the stock market. So all the information which is relevant is represented by the stock price, and the investors are rational and behave in the cost effective pattern. And EMH also assumes financial securities always priced correctly. Like there is no chance of overprice or underprice. At any given point of time, the price represents the fair price. So it is not possible for anyone to make any undue profit because of selling an underpriced stock at a more value, or nobody can incur loss because they are buying underpriced value at a higher price. Okay, so that is the main assumption of EMH. What are the essentials of EMH? In order to EMH to work or operate, so we have two types of efficiency: internal efficiency and external efficiency. In the internal efficiency, the transaction costs, brokerage, all those are nil. So the price represents the fair price, or the price which is purely applicable to the market price. Then external efficiency, so it represents all the elements which affect the marketing mix of the share price. So the price at which it is dealt at any given point of time is the fair price, or is the correct price. Degree of efficient hypothesis, if it is a weak form, that means the price is representing the historical factors of the factors which affect the historical factors of the price. Semi-strong form, so this represent the present factors which affect the share price. Strong form, which takes into consideration the historical as well as the present trends or present information happening in the market, so which talks about the strong form. Testing technique of weak form, to check if market is operating, EPH is in the weak form or semi-strong or strong form. So if you, these are the techniques earlier researchers, correlation, run tests, filter tests, these are some of the techniques which are applicable or which are applied to check if the market is running at the weak form or strong form. Like basically these are applied for the weak form. Semi-strong form, there are given tests. By applying that, one can check if market is operating at the semi-strong form, where it represents the present information which are relevant for the market price. Strong form, that means the stock price is representing the historical as well as the present information. So trading by stock exchange officials or mutual fund managers, so they would be the one who would have got all the information. So if they are indulged in trading, so that means the EPH is in the strong form. To have a quick recap, EMH or efficient market hypothesis is a theory. The basic gist of this theory is that at any given point of time, the share price represents all the information which is relevant for the fixation of the share price. That means it is like an ideal price or the fair price which is dealt at any given point of time. So no stock can be underpriced or overpriced, or nobody can make undue profit by selling an underpriced share for a higher price, or nobody can get into a loss by buying by paying more price for an underpriced stock. So the efficiency could be in a weak form, strong form, or semi-strong form. Weak form, when the stock price represents only the historical data. Semi-strong, when it represents the present data. Strong form, when it has both historical as well as present data. Semi-strong, the market price represents the present data. These are some of the references which you can refer in order to get the concept more clear. We'll meet in the next video and we'll discuss about other aspects of security analysis. Thank you very much.